going to talk about DocuSign, and the interesting thing about this is guidance was poor. The stock still trades at 38 times, down 25%, but we're going to talk about a long. And this morning I said a little something that was, if it doesn't break the low, there's only one way for it to go, and that's to the upside. But it's mostly because of what I saw happen in Gap and a few other names where you come in, doom and gloom, everybody and their mother says they got blown out, it's a beat up stock, it's going to flush today, but it has gapped down so far and the squeeze happens. Now, DocuSign doesn't have more than a 6 or 7% short interest, so it's not quite in that bucket. However, when you look at what happened here, and I'm only going to pull the daily chart back into this year, but if you go all the way back to the pandemic, this 65 level that I have drawn down here, that is your 2020 low. So you've essentially made a bottom at that 2020 low just recently here in May. And then you had that twice. So you got a huge level on the daily chart. You come in and you are gapped down below that level. You've already broken this thing and broken below it. And then you've come a little bit higher. I've seen this set up this quarter so many times in a stock that you just want to be short because it's going down, and everyday traders thinking the same thing. But if it doesn't break that low at the open, only one place for it to go, and that is to the upside. So I saw doesn't get through the low of the day, doesn't get through the low of the day. Then we are back above that 65 level. You've got a multi-year low on the daily chart that is now holding in the pre-market. That sets up two trades. One, which is only a small win, which is the breakout of the pre-market top at the open. It's a quick scalp trade. But the other one is retest that bottom. You can see the wick, hold the low, hold the line, and then grab the higher low. Now you're absolutely off to the races. And remember, you are going long in a market that is getting trashed. You had a CPI number which was way too hot and was also sending the market into its lows. And the weakest stock out there, you are going long because it was a relief rally. Shorts got to cover too. So it broke out. You're able to catch a quick $1.20 off the first leg. And then at that point, I'm thinking, where do you get out? There's only one mistake that got made here. I had this 70 level drawn out, previous support turning into resistance. I knew this is where I thought things could turn around. That's where I would want to wait to try to think about a short trade here. It put one test into 69, and then as it's curling, I take the rest of this one out thinking I need to be thinking short after this next move up. It had a wick high at 70, couldn't quite get the entry point tight enough to the high of the day, and you can see what happens after that. The key thing about this is you don't want to get married to a certain direction or a bias in a trade. Just because something is beaten up doesn't mean it has to go down. If it's already come down super far, then there's just more shorts to cover than anything else. And in that case, if you want to go with the momentum, you might just have to take the long. And I've seen this setup work far too many times. The last two times, the only thing I did with it was cover my short and not get run over. And this time, I decided, no, we're not even going to take the short. We're just going to make the long. You've got to adjust to the market that you're in. And in this particular case, these 20, 30% down moves on earnings, if it doesn't take the low, there's only one place to go. DocuSign gave you the win alongside in one of the weakest markets we've seen.